Hello and welcome to Market Domination Overtime. Stocks closing flat and a volatile week here. Our very own Jared Blickery standing by with all the headlines. Jared.
Thank you, Josh. It was a losing week in the majors. Let me show you what the charts are saying here. You can see for today, the Dow is down 83 points, or just about 17 basis points, so not that far off the flat line. NASDAQ and the S&P 500 just barely negative, but here's the 5-day price action in the Dow. You can see it's down about 0.3%, so not a big amount, but as you said, Josh, volatile price action. We saw that big drop into Wednesday, we recovered a bit, and now we're just off of those highs. We are only green for a couple of moments, a couple days this week. Now here's the NASDAQ, and you can see we started out the week green. We did have another drop, just as we did in the Dow, into Wednesday, and we're ending the week down about 0.2%. And then here's the S&P 500, down, kind of splitting the difference there, and very similar charts to the other two. But here's where it gets interesting, because as I've been noting all week, the small caps and the mid caps, even the micro caps, they've been hitting record highs. So let's take a look at the Russell 2000, which closed up just barely today at 13 basis points. For the week, though, tacked on 2%, and we were closing not too far from the highs. And unlike those majors we were just taking a look at, notice there was no big drop into Wednesday. So that was a big stock phenomenon that we're looking at there. Here's the S&P 600, another look at the small caps, just weighted a bit differently, different components. And here you can see that's up 1.7%. And then here are the mid caps, the S&P 400, also hitting record highs this week, and similar chart up about 1.3%. Do want to show you the micro caps as well, soaring even higher and farther than the small caps, up 2.3%. So let's get into the sector action. This is a large caps. This is Bitcoin, so let's show you the large cap sectors here. It was a story of real estate today. That's up the most, 1.25%, followed by industrials, energy, financials, tech, all of those outperforming. Communication services and healthcare, those were the two worst, but not even down 1%. Want to show you what happened for the week, though. Again, real estate at the top, followed by staples. Then you got industrials, energy, utilities, then materials. 4 of the top 5 here, those are defensive sectors. So this was a somewhat defensive week, at least in terms of the large caps. But again, as we were talking about, the small caps were outperforming. To the downside, communication services and financials both down more than 2%. I'm going to show you what the NASDAQ did, and let's dial that down to the intraday just so we can take a look at today's picture. Looks like we got some great chip action. We did see some strong action in the chips, but not the software sector necessarily. But you can see kind of split here over the large caps, the mega caps. Broadcom up the most of those, up 2.5%. I'm going to show us finally the semiconductors and software. Here's what we did in semiconductors today. Micron and Outstander. Performer, that was up almost 8%. And then we have software, and you can see a lot of red here. IBM in the green, up 2.5%. For the most part, a bifurcated week, even in tech, Josh.
All right, thank you, Jared. Well, tech started the year with modest gains, but if you look under the hood, not everyone is a winner. Among the biggest laggards recently, software stocks. And joining me now is Scott Kessler, third rig global sector lead for technology, media, and telecom. Scott, it is great to see you. So let's talk about this software sector, Scott. I mean, if you look at the IGV, so your software ETF, not good, Scott. It is well in the red already this year. Over the past year, it's gone nowhere. What is the issue here, Scott? I mean, is this investors deciding that, yes, you know what, AI is the death of software and I'm steering clear? Is that what's going on?
I think there is something to that, Josh. Good talking with you again, by the way. So I think there are a couple things, and I think some of those things are frankly largely related to AI. So you hit on one of them, which is AI as a disruptor, as a competitor. And I think a good example of that might be an Adobe, right? A great software company that was founded, I think, in the 1980s, that is facing a lot of competition. And one of the competitive fronts is companies, and there are a lot of them and a lot of different offerings available to people at either free of charge or minimal charge, where you're able to use AI to create content, to create images, pictures, videos, and people do wonder to what extent that will start eating into Adobe in terms of its revenue, in terms of its market share, in terms of its profitability. and in terms of its growth. So I think that's one way to think about it. And then the other way to think about it is the promise of AI that people have been investing for over the last 2 years or so hasn't really come to fruition as quickly and as powerfully as people would like. And so I think investors are, in fact, growing impatient.
So I guess, Scott, I mean, listen, what have investors been much more enthusiastic about? The chips, right? So, but to get more interested and excited about software, I would think listen, if you could show folks real, meaningful AI monetization in that sector, that would draw people in. But I don't know, Scott, what is the timeline for that? Is that 26? Do you think it's 27? Is it 28?
Yeah, look, I mean, your guess is as good as mine, but I think it's fair to say that this is coming more slowly than a lot of people would like. And whether it's, the bellwether software companies out there, or it's frankly the investors in these companies, I think there is a lot of impatience and related uncertainty. You think about a name like a Salesforce.com, for example. I think a lot of people have looked at that company as kind of a bellwether when it comes to the cloud and a bellwether when it comes to AI. And the company definitely has talked about those super kind of trends over the last number of years. The problem is exactly what you highlighted. To what extent can they show that AI is already helping their business in a big way? And I think it's hard to show at this point. And one of the reasons is that customers aren't seeing the kinds of return on investment that they might have expected when they made these related investments. And I think that obviously is one of the issues is causing folks in the marketplace to press the pause button a little bit on related investment and spending.
So if I'm an investor, Scott, and I'm screening for opportunities in the software sector, in your opinion, as beaten down as it is, what am I screaming for in your opinion?
So look, I mean, there are a couple things to keep in mind, right? Like I was looking earlier at the S&P 500 Software Industry Index. And it was fascinating because if you look at it from April of last year into October, right? So really from when the Trump tariff announcement came out at the beginning of April, approaching and into earnings season, I guess for Q3, I mean, you saw an increase of 50% or so, a really dramatic jump after that decline in April, of course. But then since then, as you alluded to, I think that index has been down approaching 20%. And so I think there are a lot of people who are wondering, hey, have we bottomed out here? Are the fundamentals going to improve? You look at a Salesforce, the expectations are for growth for maybe kind of 10% or more over the next few years. Yes, margins may improve, and the valuation, look, if you compare it to the overall market, doesn't seem stretched, but I think people need kind of a positive catalyst, and it's really hard to determine what that might be, especially ahead of earnings. So when you're thinking about TMT and technology more broadly, I think one of the best ways to think about this is where is there kind of secular growth and where is the consensus perhaps wrong? I mentioned Adobe a little earlier. They're fighting a two-front war. They're not only fighting against those businesses and apps that are letting users use AI to create content, but also the Canvas of the world that are really making really sophisticated tools available for essentially free. And so they're fighting this battle, and I think that's kind of a challenge. But I think the company has made a very good case that when it comes to companies, professionals, workflows, Adobe kind of owns that. So I think you got to kind of look at the fundamentals, where the secular growth is, and kind of who has kind of the, I don't know, the moats around their businesses that can kind of sustain the perceived and actual challenges from AI.
And finally, Scott, I'll just get you out of here on this. Since, listen, we're talking here about the great AI trade and trend. I want to get your thoughts on this. Just where we are, Scott, and where you think we could be headed. In the context, Scott, of this Taiwan semi report we got this week, where they say, listen, we're expecting expenditures of as much as $56 billion this year, right? They're looking for revenue growth of close to 30% in 26. That was faster than what the street was estimating. I mean, you saw that report, you saw those headlines, Scott. What did it suggest to you about the great AI trend and where we're headed?
You know, it's phenomenal to think about this, Josh, but semiconductors really, as you alluded to earlier, has been the place to be, because it seems like the hyperscalers and countless other companies are doing everything they can to build out capacity and capability. We've done work indicating that there is a current super cycle when it comes to memory that will go well past this year. So there's a lot of demand, and frankly, companies seemingly aren't going to be able to meet that. So I think there's a lot of warranted optimism around semiconductors. But as you touched upon, where the rubber meets the road is when you're trying to roll out those applications and the benefits that those afford to your clients and your end users. And it seems like there's some squishiness there at best. So people need to be selective. They need to look at fundamentals, but there is a lot of growth out there to be had. It's just a matter of where to look for it.
Scott, great to see you as always. Thank you.
Thanks a lot, Josh. Have a good weekend.
You too. Coming up, homebuilder sentiment dips in January. We hear what's weighing on the industry next on Market Domination Overtime. Homebuilder confidence moving lower for the first time in months. Builders starting out the year feeling the weight of rising construction costs and affordability concerns. National Association of Home Builders CEO Jim Tobin joins me now for more on this challenging housing market conditions. Jim, great to see you. So let's dig right into this, Jim. So builder confidence slipping here to 37. What do you make of that, Jim? And what do you chalk that up to? Rates? Is it prices? Walk me through what you're hearing and seeing.
Yeah, down two. It's erasing or at least kind of retreating from 4 months of small incremental movements to the upside. So I think a couple of things. One, we have gotten we're in the middle of the winter season. We're still a little tightened up with interest rates. We've seen this kind of steady march and hold at about 6.25. So that's kind of put the market in a pause. Are we going to move lower? We actually have seen the market move lower over the last week. As President Trump's policy of having Fannie Mae and Freddie Mac buy mortgage-backed securities, we actually saw the mortgage rates drop really, really close to 6%. And a lot of our survey came in before that data point. So I suspect that if our survey was out in the field, a little bit longer, we might have seen maybe even a move to the positive. But it's just, rates are holding tight. Construction costs. It's the middle of the winter season. And we're waiting to see what the spring season is going to hold for us.
Regionally, it was interesting, Jim. It looks like builder confidence was weakest in the South and West. What explains that?
Well, we've seen this over the last few months, and that is price drops. A lot of home builders, I think 40% of the home builders out there are discounting their product to move it in this market. So naturally, the South has always been the hottest, the Southeast, the hottest markets traditionally over the last several years, the West as well. And so I think it's just pessimism as they still try to eat through sitting inventory.
You mentioned the 30-year fix, Jim. I'm just looking at Mortgage News Daily. They've got the 30-year fixed here at 607. You look at that level. I mean, is that enough to meaningfully restart demand, Jim?
I still think we have to tick into some fives here to really get people moving. But it's a good sign. We anticipated this when the president made the announcement about Fannie Mae and Freddie Mac. We've seen that realized now in these mortgage rates. I still think we have to get going. That said, I saw a report earlier this week. I'm sure you saw it too, Josh, where more mortgagees have rates in the 6% range than they do in the 4% range or even the 3% range. So for me, that means that we are starting to see market equilibrium. Maybe we're going to start to see people that are willing to move, and absorb, high 5% mortgage rates.
Sticking with Trump, Jim, I mean, you saw this. I want your take on it. This proposal banned big institutional investors from buying single-family homes. I'm interested to get your take on that from a builder's perspective. Here's what the journals editorial board had to say, Jim. Not fans. They say Mr. Trump's investor ban won't expand the supply of housing or reduce housing prices. We hope Congress rejects it. I'm interested to get your thoughts, Jim.
Anything that takes investment out of housing and housing production in particular gives me heartburn. I would much rather see some proposals that stimulate housing supply. And so you have to remember, back after the great financial crash, we had, large capital investors came in and bought up a lot of foreclosed properties, and something happened along the way after they did that. Number one, they found that they could manage scattered site properties. And number two, they found a market for single family rental, and they stayed in that space since then. I firmly believe that if you want to discourage a large investment in housing, let's make ownership more affordable. People want to live in a single family home. They want the single family lifestyle. And when they can't afford to own it because interest rates are high or because home prices are high, they're going to rent it for a while. And there's a market that's been created for single family rental. And by the way, it's such a small portion of the overall housing market. In fact, single family rental is about 8% of the market. And actually, large institutions are only about 3% of the marketplace. A lot of that single family rental are mom and pop operators, members of the National Association of Home Builders that may have built a couple single family homes and rented them out because that's part of their retirement and their financial security. So I don't think we should be pulling any kind of capital out of the markets right now.
Well, speaking of heartburn, Jim, I wonder what the heartburn level did when you read this one, which I have to ask about. This was the report in the Journal. The administration going after home builders' stock buybacks, Jim. It reads like they're even hinting at possible penalties of some kind. I mean, how do home builders respond to that? I guess the idea being, more capital should be going to lowering prices. But what'd you make of that headline?
Well, as the president said, he wants to get the home builders in the nation building, and they're going to look at all kinds of different levers to do that. I would prefer to find some supply side stimulus out there. We're anxious to see what the president's going to unveil next week in Davos. We've been talking to the White House about supply side, also some demand side items as well. The president recently announced that maybe they're going to look at allowing 401ks to be tapped for home purchase or down payment purchases. We can't go all demand side here. We saw what happened over the last several years. Supply just isn't there yet. So what we need to do is a combination of supply side and some demand side. But we've really got to make sure that we hit the ground running for the spring season. And this is the time to do it. So again, it's very anxious for what the president's going to roll out. Again, we're focused on the supply side. Our members are ready to go.
Well, so at Davos, Jim, we have reports suggesting what the president's going to talk about, that he's expected to announce a plan to let Americans use 401k savings for down payments on home purchases. I mean, is that going to help affordability, or is that going to add more demand in a supply constrained market and actually push up prices? What do you think?
Yeah, it's a demand side stimulus, so it is going to put more pressure on the demand side. But that said, the down payment especially for first time or first generation home buyers, that is the hardest thing to overcome if you've got to come up with 10, 15, or 20%. So being able to tap your 401k, that's a good thing. But again, that's a demand side stimulus. We really need to see some policies that are going to push the supply side so we can meet that new demand. New demand's only going to jack up the prices on existing properties. Congress is actually working on some supply side stimulus legislation. The Senate's passed theirs, House is working on theirs. So there's a combination here: what the president's going to propose, what Congress is working on, and much of what the president might throw out there, that's going to have to go through Congress too. So there's a long way to go, but I think the promise that the president and the administration and Congress are focused on housing and housing affordability, that's a good thing, and I'm hopeful that kind of catapults us into a really a better 2026 when it comes to home building.
It's interesting, Jim. I'll just end here. We're talking. Listen, the president is focused on housing and affordability, and I get it. And he's getting creative. And listen, he's pulling all kinds of levers. We were just talking about it. Rates, MBS. But at the end of the day, to your point, Jim, you got to boost supply if you want to bring down prices. And you're talking about what's happening with Congress, but a lot of this, Jim, and we've talked about this, the two of us, it's going to come down to changes at a state level and a local level about zoning laws and building regulations and land use. Are you seeing that happen?
Yeah, little by little, believe it or not, we are seeing that happen. We're seeing localities and states stand up for housing. We've seen it in California. We've seen the governor take on, LA, who wants to continue to ratchet down on housing supply and put in rent control and all kinds of different things to keep people from being able to afford a home or an apartment in LA. So I think it is catching fire across the country. But again, having the president talk about it and be able to use his levers, there are some of those pieces of legislation that I talked about in Congress. They actually are looking to put some carrots and sticks when it comes to local governments and housing production. The president's talked about it too. They have, powers of grant, whether it's transportation grants or HUD grants. There are some ways to hold some feet to the fire. I prefer not this. I prefer the carrot than the stick approach. But look, so many local governments, they want to reject housing because they're NIMBYs. They want to deny homeownership opportunities for people. We have to start calling them out. This is about making sure that people can have financial security and safe, decent, affordable housing. It's time for everybody to get on board.
Jim, always great to have you on the show. Enjoy the weekend.
You too. Thanks, Josh.
Time now for what to watch. It's a shortened trading week. The markets are closed Monday in observation of Martin Luther King Jr. Day and will reopen Tuesday. Investor attention will be focused on the Swiss Alps as world leaders and top executives descend on Davos, Switzerland for the World Economic Forum. President Trump set to speak Wednesday and address affordability in the housing market, including a proposal that would allow Americans to tap their 401ks for down payments. And the White House's feud with the Federal Reserve heads to the Supreme Court. On Wednesday, oral arguments are scheduled in President Trump's bid to fire Fed Governor Lisa Cook, which could have implications for the president's frustrations with Fed Chair Jerome Powell. In the meantime, earnings season picking up steam with a few marquee names reporting results, including Dow Components, Procter & Gamble, 3M, and Johnson & Johnson. But all eyes will be on Netflix. Netflix is set to report Tuesday after the close. That stock getting crushed over the past 3 months, down about 25% as investors weigh the company's future in 2026 with its pending deal to acquire parts of Warner Brothers Discovery. And turning to economic data, the Fed's preferred inflation gauge, that's personal consumption expenditures, is coming out on Thursday. Ford announcing its big return to Formula One racing at the Detroit Auto Show. The legendary automaker is partnering up with Oracle Red Bull to develop a next-generation unit to be used in the 2026 F1 season and beyond. And Yahoo Finance's senior autos reporter Pras Subramanian caught up with Oracle Red Bull driver Max Verstappen to discuss the new season.
Max, tell me about the new season. The new cars coming up here with the Ford powertrain. How do you feel about the new season coming up now?
In fact, everyone's excited. I mean, it's of course still very early. We're still mid-January, so just step by step. We remain calm. We're very focused, and it's not going to be that straightforward and easy for everyone with these rules. But we're just looking forward to get out on track now.
It's a nice looking car for 2026. Last year, had a pretty bruising battle at the end. You almost made that 5-time world champion, right? Almost had that. How would you describe that year? Was it tough? Was it fun? Was it a mix of both?
It was all right. Yeah, I mean, it was a better ending, I would say. We had a bit more fun in the second half, and at least we kept it exciting until the end.
I know we're a finance audience. I know you own your own racing team. Are you going to follow the footpath of other athletes and buy other teams, maybe other sports, other racing teams, maybe?
Step by step. I don't want to rush into things as well.
After your career, after you're done with F1, what's next for you? Is it Le Mans? Is it more sim? What do you want to do?
Probably more like endurance style racing, or at least be involved in it as well. Yeah.
Maybe a new Nürburgring record, perhaps, right?
It's not about the record. At the end of it, doesn't matter. You just want to go out there and win.
Thank you, Max. Really appreciate it.
That'll do it for today's Market Domination Overtime, but don't go anywhere. It's Asking for a Trend coming up next.